Assalamu alaikum and welcome to the Oasis Focus and Finance Show. I'm your host, Shafiq Morton. As always, it's great to be with you. In last week's show, we had a look at death and disability and how it affects your retirement fund. Today, we're going to have a discussion on divorce. After the break, we'll also have a look at debt and insolvency. Joining me from the Oasis Advisory Services in studio today, Jehan, Ebrahim and Ebrahim Rawoot. Ladies and gentlemen, Assalamu alaikum.
Wa alaikum salam, Shafiq.
Ebrahim, let's start off with you. There is a legal framework surrounding divorce and the issue of retirement funds, and I believe it was amended, I think, in March 2009. Tell us more.
Well, Shafiq, under the new law, if you are married in community of property or under what we call the accrual regime, then your spouse would be entitled to a portion of your retirement fund or your pension fund benefits as at the date of when the divorce is finalized or complete. Now, the law really determines what the amount is that your spouse will be entitled to in terms of, what is referred to as your divorce order. Important to note, Shafiq, that, your retirement savings, is really meant to be utilized at retirement. So what you as, a spouse and, your non-member spouse need to do is really, try and negotiate maybe not using your retirement fund savings, but maybe other forms of property, other forms of assets in order to, come to an amount that is going to be utilized as part of your settlement. However, if that's not the case, there will be a calculation. That calculation will then be determined from your retirement fund savings, and that will be the amount that will then form part of this divorce settlement.
Now, there's certain steps that have to be followed, aren't there? There's a certain procedure in the case of divorce with regard to retirement funds. Take us through that.
Well, I think the first step is that, as couples, we need to first of all identify where all our retirement fund savings are housed, where it is being invested. So the first thing we need to do is identify whether we have pension or provident funds. Some of us might have preservation funds, we might have a retirement annuity fund. So taking all these assets into account, it needs to be documented, it needs to be correctly named in the divorce settlement. Now, the law then allows for your pension fund administrator, which is the person that administers your retirement fund, then to deduct a portion of your pension fund, and that will then be used to pay to the non-member spouse. And obviously that amount is then determined. The exact amount obviously will be dependent on what type of policy you're having, because remember, pension funds, provident funds, retirement annuities, there's certain different rules with regard to that. Now, let's take the easy one. If you take a pension fund or you take a provident fund, this is as a direct result of you belonging to a company. That company has then imposed that you belong and contribute to that pension and provident fund. Now, how you determine what the value is then determined on what that amount would have been if you had to resign today. That we refer to as, they call it the member's cash withdrawal benefit. So that amount would then be utilized in the calculation to determine what is going to be due to the non-member spouse. If you look at a retirement annuity, it's slightly more different because here you took the retirement annuity out of your own. So the growth on your retirement fund is now determined as, the aggregate of your contributions plus 15.5% simple growth. Now, if you look at, the conditions, they say when markets are tough, markets are low, your calculation that could provide the amount is in greater than your member's share value. So if you look at your Pension Funds Act, it's really trying to limit the growth on the fund that would be needed to be transferred to the rate that is equivalent to the rate of your pension fund. So there's no unfair, disadvantage to the member. There's no disadvantage to the non-spouse member. In the case of a preservation fund, it's exactly the same as if it was a pension or provident fund. So what would have been the value as at the date that you would have withdrawn, and that amount would then be included. Now, Shafiq, when there is a divorce, obviously there's certain squabbles that's happening. People are now starting to question the amounts. So yes, you may then go to the pension fund adjudicator to say, is these amounts correct? Number one, are they, am I unfairly being treated? But I think what we need to understand is your pension fund adjudicator is going to follow strict interpretation of the Act. And what the Act says is what the pension fund adjudicator is going to follow by.
Now, Jehan, Ebrahim has just spoken about growth on pension fund. And to me, it seems to affect what the non-member spouse might get in terms of funding. So how do we understand this? Give us some clarity on the growth aspect of what we're talking about.
The amount of gross growth on your retirement fund may be subject to a number of deductions before you get to see the important net growth on your retirement fund. For example, you'd need to establish whether the court awarded an amount of your funds to any former spouses in terms of earlier divorce orders. In these cases, the amount awarded to previous spouses may be deducted first and will not form part of the growth on your retirement fund available for distribution to later spouses. In addition, if there is more than one divorce order that has to be deducted at the same time, such orders must be dealt with in accordance with the hierarchy of maintenance orders first and then in the order of the rulings made upon divorce. You are also able to deduct from the growth on your retirement fund any pension-backed housing loan or housing guarantee granted prior to the court orders. This is irrespective of whether the amount is due and payable or not. Once again, the respective divorce order may not exceed the member's available growth on your retirement fund at any given time, so you will not be required to transfer more than what you have earned.
Ebrahim, any tax implications when one implements such transfers? The taxman is quite inevitable, isn't he?
Oh, certainly, Shafiq, they always say there's two guarantees in life. The one is death and the other one is taxes. But, if you take any amount that is being transferred to another retirement fund following the divorce on or after the 1st of March 2009, and you mentioned it at the beginning of the interview, that will not be taxable in terms of your transfer. However, any lump sum that you decide to take in cash, that will obviously attract certain taxes. And there's, obviously a 25,000 Rand that is tax-free. It's not a lot of money, but that is what's due to you as per the tax tables. Therefore, the spouse that was not a member of the retirement fund, so we refer to that person as the non-member spouse, ideally what he or she wants to do is open up a new retirement fund. So as at the date of divorce, I'm entitled to this amount of money. What I really want to do is preserve it in its true form and really transfer it into another retirement fund. What are you doing? You're actually protecting yourself from this tax deduction that would have really wiped out a sizable amount of your retirement fund savings. However, what we also need to understand is that, there are certain rules with regard to changes relating to the amendment of, the Divorce Order Act and the Maintenance Order Act. But I think what is important, Shafiq, is really what we need to understand is you're going to be withdrawing from this retirement fund. So if there's multiple withdrawals, whether it's from a pension fund, a provident fund, a preservation fund, they add all these amounts together. And that will become what is called your consolidated amount or your aggregate amount. Now, whether you decide to take this money in cash today, there will be certain tax implications. You might have decided to say, well, I'm going to take a portion of it and leave it until retirement. The day when retirement comes, we then have to add up all these withdrawals again and recalculate what is going to be the tax benefit that's due to you. So we must not be, short-sighted to say, well, there's a bit of money that's coming to me. I want to take this money, I want to enjoy it, and, I'm really negatively impacting my ability to retire comfortably. And that is, whether it's at age 55 or 60 or 65. So ideally, there's options available, and I think as individuals we need to be responsible enough to say what was the original purpose behind these monies. And the original purpose in my eyes is really to ensure I'm going to live a retired comfortable life one day.
What about a post-retirement annuity policy which gives a person a regular pension?
If a member does decide that he or she wants to take the money in cash, there's a certain process that we need to follow. We call it the 4-point process. So a fund will apply for the tax directive for the amount that is allocated in the divorce order. The amount will then be taxed in the hands of the spouse. The tax payable will be deducted from the benefit and paid over to SARS, and the final amount after tax is then paid into the member's or the spouse's bank account.
Ebrahim, what about the case of a post-retirement policy that's paying out a regular pension? How does a divorce affect that?
Well, it's important to note that a post-retirement policy, or what we refer to as a living annuity or a pension annuity policy, it cannot be transferred, it cannot be ceded to another person, to another institution, attached by a court to recover some sort of debt. However, what is the main responsibility of a living annuity or a post-retirement annuity? The main responsibility is to pay you a pension. and from that pension you then live as if it was a salary that you're earning. So, what in essence would happen is, prior to your divorce, the court will then decide what is this amount that the policyholder was earning, which is his or her pension, and take a portion of that amount and incorporate that into what is referred to as a maintenance order. Now, yes, some non-member spouses would want to say, well, I want to receive this pension upfront. I don't want to wait for the member to pay me a monthly maintenance order. Most insurance companies don't do what is referred to as, the splitting of an annuity. So what they will do is they'll put the responsibility back on the policyholder to say, well, you know what, I'm going to pay you your pension every single month. We'll deduct certain tax from that, which is your PAY, and from the net amount which is now paid into your bank account, you will then be responsible for paying your obligation, which is your maintenance order. So really what insurance companies doing is saying, we don't want to get involved in the issues of maintenance. We'll pay you the pension, and from that pension you then pay the maintenance order amount.
Jehan, as we start to conclude our section on divorce and how it affects retirement fund products, is there any further aspects that we would have to consider?
The best thing to do, Shafiq, would be to establish your individual rights. The conditions should be contained in an anti-nuptial contract, and should the couple then decide to get divorced, the contract would then become binding. The best option would be to speak to an attorney to stipulate the terms and conditions of the marriage.
I think that's also so important, Shafiq, and Jehan mentioned, anti-nuptial contracts. In the heydays, there used to be in community of property. There's now anti-nuptial with accrual, without accrual. So there's so many different options available. And, I think as individuals, we need to seek professional guidance and advice as to what is going to be the best option, if there is a divorce order. So, I think, it's important that we ensure that we establish all the options available to oneself.
Now, Jehan, your comment on the fact that there are people in South Africa who are changing their jobs so that they can use their pension funds to either pay debt or to get ahead in terms of debt.
You won't believe how often I come across situations where people actually change their jobs just to access their retirement savings in order to get themselves out of debt. So I'm really happy you asked this question. I cannot stress enough what a bad idea it is to withdraw your retirement savings before you actually retire. Many people just don't seem to appreciate that when you cash in your retirement savings early, irrespective of what your reason is, you are effectively reducing your overall quality of life at retirement. Taking out your money when you are young and using it to settle debt may seem like a good idea at the time because you're thinking you have plenty of time to make up for it later on in your working life. But here's the simple truth. It's not a good idea to cash in your money at any time. Retirement savings is meant for one stage of your life, and that's at retirement age, not a moment before. I've come across countless situations where people think, let me cash in my retirement funds, I'll save for it with my next job. Shafiq, can you guess how many are happy with that decision at retirement?
I can imagine absolutely none.
Absolutely, and you are right. The reason why you need to leave your retirement savings alone and access it at retirement is very simple. Your savings needs time to grow because you benefit from compounding. I know we keep saying preserve your savings, saving over the long term is worth it, but I need to illustrate by way of an example the actual impact of cashing in your retirement savings to settle debt versus leaving it until retirement. I have a client who has just retired, and while he does access a regular retirement income, it is by no means anywhere near what he could have enjoyed. This is an actual case, and I'm going to go through it in detail because I want our listeners to understand the situation this retired client is currently in and just how serious this is. For the sake of this illustration, let's call my client Mr. Sparrow. Mr. Sparrow recently retired at age 65. He has had to find him part-time employment at his age to supplement his income. Now, while I know he's still able to work and contribute meaningfully at his age because he is a seasoned professional, his primary reason for work is because he needs additional funding to keep pace with his day-to-day needs. Now, Mr. Sparrow was a senior manager at his firm when he retired. He had a very good job, a fantastic career, and has a beautiful large home, a wife, and 3 well-educated children as well as 2 grandchildren. To an outsider, he is all set for a happy retirement, so why the need for additional income? Here's why. He still needs to pay off his bond for another 3 years. His wife has a chronic medical condition and requires medical treatment monthly, some of which is not covered by his medical aid, and he needs to continue making contributions to his medical aid facility monthly. He needs to cover monthly household expenses like water, electricity, food, and petrol. His current retirement savings only covers half of his monthly expenses. He has only made contributions towards a unit trust account in the last 10 years, which has been set aside for emergencies.
Jehan, certainly doesn't sound like it's a very ideal situation. I mean, you're talking about a seasoned professional, educated, probably highly qualified, but to be working at 65 years of age, really, I don't think anyone really wants to be in that position, to be able to do that.
Definitely not, Ebrahim. Let's look at the reason why Mr. Sparrow is in this position, in spite of his good job and highly paid position. He spent a large portion of his early career acquiring really unnecessary items and experiences such as an extravagant car, expensive clothes, and he also went on a few overseas visits. 90% of what he did in his early years was funded with credit. The only savings he made at the time was to a retirement fund. When he got married, he was still paying off debts. He then had additional expenses to deal with, buying a house, having 3 children, paying for education, and all day-to-day expenses. He was the only breadwinner. The credit card was being used as a monthly lifeline, and he was basically running his household on a cycle of debt. He changed jobs at age 40, cashed in his retirement savings at the time to pay off his credit card debt. He also paid a huge amount of money over to the tax collectors. At 45, Mr. Sparrow was the recipient of funds from his late parents' estate. It was a sizable amount and he used that to pay off his bond. He also took his family on Hajj. At 48 years, Mr. Sparrow took out a second bond on his home to pay off his children's education. At 50 years, Mr. Sparrow changed jobs, but it was then that he came to Oasis to preserve his retirement fund savings, and it was only then that we were able to provide him with the financial guidance and counseling he really needed. Now, I know you're sitting there and thinking, how could he make these obviously bad decisions? Of course, with hindsight, you can see exactly where he went wrong, but the reality is that there are many people out there making these decisions today as a norm rather than as an exception. Mr. Sparrow's situation is unfortunately the exact situation that many people out there are currently in. And I want our listeners to pick up the phone and call us. We will assist you to rectify the situation and help you with a plan towards getting out of debt. In Mr. Sparrow's case, he took his retirement fund savings out when he was 40. Effectively, he has only given himself 25 years to save for his retirement. And you may be sitting there and thinking, that's a long time. But hold on to that thought and let's look at the figures. At 40, Mr. Sparrow's retirement savings was 560,000 Rand, but he took that amount out of the savings pool and used all the cash. Presently, at 65, Mr. Sparrow retired with 3,864,153, and he receives a 5% drawdown monthly, giving him approximately 16,101 Rand of gross income per month. But had he left his 560,000 Rand in his retirement pot and preserved it when he changed jobs, he would have effectively retired with a total amount of 7,699,299 Rand. That would mean in his retirement years, he would have received a gross income of 32,080 Rand per month at a 5% drawdown.
Yeah, Shafiq, I think, it's important, and, Jehan mentioned so much important aspects within this whole exercise. And unfortunately, it's a real life situation, and many of us find ourselves in this position. But I think, really what we need to understand is that many of us are going to change jobs. The grass is greener on the other side. The question is, what do we do with our pension fund benefits, with our retirement fund benefits? It's so easy. 85, 90% of us decide, let's cash it in. I still have time on hand. I'm 40 years of age. I can, invest for another 25 years. But what we've done is, and it's so real and evident in this example, that we have literally now had to, at 65 years of age, go find new work. I think it's unfair on us as individuals, because at 65 you really want to be enjoying the benefits and the fruits of your hard labor. Secondly, take that decision at that point in time when you change jobs to preserve. Tell yourself, I never had access to this money while I was employed. Don't find every reason in the textbook to now want to have access to that money. So really, the impact is so substantial. 25 years might sound like a long time, but take the compounded effect, the time value of money, and you quantify that over a 25-year period. It's the difference between retiring comfortably or standing in the queue asking for state pension, asking for financial aid from family, or really at 65 years of age having to find employment. And I don't think any of us should be putting ourselves in this position.
I agree, Ebrahim. Not only would this additional funding have alleviated the need to work, but it would also have given him additional flexibility to having paid off his home, allowed him to save money for his grandchildren, who I know he just dotes on and really wanted to give them something towards their future. But it was not possible, as we needed to preserve as much of his funds as possible so that it will last throughout his retirement years. So my advice, save early. Don't ever cash in your retirement savings, and come speak to me or my colleagues if you find yourself in a difficult financial position. We will assist you.
Ebrahim, in conclusion, it does seem as if using retirement funds to try and resolve debt issues does become hugely complicated. What are your general guidelines?
You know what, I think the conditions relating to debt, as you mentioned, it is very complicated. And what we're always going to tell people is seek professional guidance, whether it's a lawyer, whether it's an attorney, a financial advisor, and let them, obtain the exact legal position that would be relevant to you in terms of your particular circumstances. Why is it so important? Shafiq, when we're working, we're contributing to a retirement fund, but then we also incur this, what we refer to as long-term debt. Whether it's a bond, whether it's a motor car, these are all assets, but we need to also be careful that we don't use our retirement fund savings as, as collateral to the debt that we're incurring. We don't want a situation that, while you're working, you're servicing this debt, but the day you retire, you still have the debt. And what then happens at retirement, they offset the cash portion that's due to you to be effectively used to settle the debt. And what does it mean? It means you're working towards a situation where the pension that you're now earning is now being considerably reduced because of the lack of cash and the high debt that you still have. So a very simple rule, start saving early, don't cash in your pension fund, don't use your retirement fund as a solution to settle debt. Settle your debt during your working career and make sure that at retirement, and use your retirement fund savings in order to be able to retire comfortably.
Ebrahim, Rawoot, thanks for that. Jehan, Ebrahim as well, for discussing the effect of divorce and debt on our retirement funds. Shukran.
Thank you.
Thank you.
And that concludes this edition of the Oasis Focus and Finance Show. Special thanks to our guests, Jehan and Ebrahim, who spoke to us about the effects of divorce and debt on retirement fund products. Should you wish to contact Oasis, you can call 0860 100 786 or email info@oasiscrescent.com. Until next time, I'm Shafiq Morton. Assalamu alaikum wa rahmatullah.